80% of the world's silver refining capacity just went offline. Not gradually, not over months, overnight. January 1st, 2026. While you were celebrating the new year, China erected what is now being called the Great Silver Wall. And the ripple effects are already visible across every market on the planet. Silver hit $78 this morning. Shanghai is trading above 80. The gap between paper and physical has exploded to $12 per ounce. And Elon Musk, the man building the largest electric vehicle company and solar infrastructure empire on Earth, just issued a public warning. Quote, "This is not good. Silver is needed in many industrial processes." End quote. When the CEO of Tesla is publicly concerned about silver availability, you should be paying attention, because this is not about investment speculation anymore. This is about industrial collapse. This is about supply chains breaking. This is about governments scrambling to secure materials they were told would always be available. And it is about the biggest wealth transfer in commodity market history happening right now while most people are still asleep. Let's start with what actually happened. China did not ban silver exports. That is technically incorrect. What they did is far more strategic and far more devastating. On January 1st, new regulations went into effect that require any company wanting to export silver from China to obtain a special government license. Not a simple permit. A 2-year strategic approval that requires the company to produce at least 80 tons of silver annually and maintain $30 million in credit lines. Out of hundreds of silver exporters in China, only 44 companies qualified. 44. That means every small and mid-sized refiner, every regional processor, every company that used to freely ship silver bars to London, New York, Tokyo, they are now cut off. The tap has been turned off. And China is not doing this randomly. They are doing this because they looked at their industrial future and realized they cannot afford to export strategic materials while trying to dominate solar energy, electric vehicles, artificial intelligence infrastructure, and military technology. China produces between 60 and 70% of the world's refined silver. Not mined silver. Refined silver, the difference matters. Many countries mine silver ore. But refining that ore into the high purity bars that industry requires, the capability is concentrated in China. They built that infrastructure over decades while the West was busy financializing everything. And now they control the choke point. When 70% of global supply is suddenly restricted by licensing requirements and export quotas, the entire pricing mechanism breaks. And that is exactly what we are seeing. Silver in Shanghai is trading above $80 per ounce. Silver on the COMEX in New York is showing $75 to $78. That is a gap of anywhere from $2 to $12 depending on the moment and the contract. In a normal market, arbitrage would close that gap in seconds. Traders would buy in New York, sell in Shanghai, pocket the difference, and the prices would converge. But the gap is not closing, it is widening. Because the arbitrage requires physical delivery, and the physical metal cannot move from west to east fast enough to matter. The vaults in New York do not have the metal in the quantities needed. The vaults in London are being drained. And the metal that does exist is locked up in rehypothecation schemes where the same ounce has been promised to multiple entities. This is the moment when paper markets lose their credibility. When the COMEX says silver is 75, but you cannot actually get delivery at 75, then the COMEX price is fictional. It is a number on a screen that represents nothing real. The real price is what someone with physical metal can demand from someone who needs it. And right now, that price in Asia is over $80 and climbing. Elon Musk's warning is not casual commentary. Tesla uses silver in every vehicle. Solar panels require silver paste for electrical conductivity. SpaceX satellites require silver for thermal control and electrical systems. When Musk says this is not good, he is not talking about his stock portfolio. He is talking about his ability to manufacture products. If silver becomes unavailable, or if the price doubles or triples, the cost structure of electric vehicles changes. The cost structure of solar installations changes. The entire green energy transition that governments have mandated, that depends on affordable silver, and affordability is about to disappear. Let's talk about the inventory situation because this is where the crisis becomes undeniable. COMEX registered inventories, the silver that is available for immediate delivery, are down 70% since 2020. 70%. The London Bullion Market Association vaults have lost 40% of their silver over the same period. Shanghai Futures Exchange inventories fell below 500 tons in November, the lowest level in 10 years. And remember, these are the visible inventories, the official stockpiles, the metal that is supposed to be there to balance supply and demand. If the visible supply is collapsing, what does that tell you about the invisible supply? It tells you there is no buffer. There is no secret warehouse full of silver waiting to flood the market. There is no strategic reserve that governments can release to stabilize prices. The metal is gone. It has been consumed by industry, and the mining supply is not increasing fast enough to replace it. Here is the math that nobody wants to talk about. Global silver demand in 2025 was approximately 1.24 billion ounces. Global silver supply, including mining and recycling, was approximately 1.01 billion ounces. That is a deficit of 230 million ounces in 1 year. This is the 5th consecutive year of structural deficit, which means for 5 years straight, the world has been consuming more silver than it produces. And it has been filling that gap by draining above-ground stockpiles. But stockpiles are not infinite. Every ounce pulled from a vault is an ounce that cannot be pulled again. And we are now at the point where some industrial regions have 30 to 45 days of accessible silver reserves. 30 days. If supply stopped tomorrow, factories would start shutting down in a month. That is not a theoretical risk. That is a measured timeline. Now let's address what China's move actually means strategically. This is not just about silver. This is about resource nationalism. This is about China deciding that in a world where the West is trying to decouple supply chains and rebuild domestic manufacturing, China is going to make sure it controls the materials that matter. They did this with rare earth elements years ago. They restricted exports, prices spiked, and suddenly every country realized they were dependent on China for materials essential to defense and technology. The same playbook is being run with silver, and the timing is not coincidental. China is in the middle of the largest solar build-out in human history. They are installing more solar capacity in 1 year than most countries have installed in total. Every panel requires silver. They are also scaling electric vehicle production. Every EV uses more silver than a traditional car. They are building 5G infrastructure, AI data centers, military electronics. Also, all of this requires silver. And they have decided they are not going to export their silver so that the West can build competing industries. This creates a bifurcated market, a two-tier pricing system. If you are in China and you are a state-approved industrial user, you can buy silver at controlled prices because the government wants domestic industry to thrive. If you are outside China and you need silver, you are competing in a global market where supply has been cut by 60 to 70% overnight. The result is predictable. Prices outside China are going vertical. And this is just the beginning. Because once other countries realize what is happening, they will start hoarding too. Chile will restrict lithium. Australia will restrict rare earths. Every country with strategic materials will look at the China playbook and copy it. The era of free-flowing global commodity markets is over. We are entering the era of resource protectionism, and silver is the first major casualty. The Venezuela situation adds another layer of chaos. On January 3rd, the United States launched a large-scale military operation against Venezuela, captured President Maduro, and flew him to New York to face narco-terrorism charges. Whether you agree with that action or not, the market impact is clear. Venezuela holds the largest proven oil reserves on the planet, 17% of global supply, 300 billion barrels. The U.S. has now said it will run Venezuela and tap those oil reserves. This creates massive geopolitical uncertainty. Oil prices are spiking, safe haven demand for precious metals is spiking, and the entire global order is being rewritten in real time. When the U.S. is conducting regime change operations in oil-rich countries, when China is restricting exports of strategic materials, when global supply chains are fracturing along geopolitical lines, the flight to hard assets accelerates. Silver is both an industrial metal and a monetary metal. It benefits from both industrial demand shocks and from safe haven flows. Right now, it is getting both. Let's discuss what happens next, because this is where positioning matters. The current price of $78 per ounce is not the top. It is not even close to the top. Bank of America is forecasting silver between $135 and $309 per ounce. Other analysts are talking about triple-digit prices as the baseline scenario. These are not wild speculations. These are projections based on supply deficit math. If demand is 1.24 billion ounces and supply is 1.01 billion ounces, and if China restricts exports by even 50% of their previous volume, then the global deficit becomes catastrophic. It goes from 230 million ounces to potentially 500 million ounces or more per year. There is no amount of price increase that can bring new supply online fast enough to close that gap in the short term. Mining projects take 5 to 10 years to develop. Refining capacity takes years to build. The deficit will persist for years. And during that time, price must rise to a level where demand is destroyed, where factories cannot afford to use silver and must find substitutes or shut down. But here's the problem. For many applications, there is no substitute. Silver is the best electrical conductor. It is the best thermal conductor. It kills bacteria naturally, which is why it is used in medical devices. It reflects light better than any other material, which is why it is used in mirrors and coatings. For solar panels, you can reduce the amount of silver per panel, but you cannot eliminate it without losing efficiency. For electronics, you can redesign circuits, but that costs time and money, and the result is inferior. For military applications, you cannot compromise on performance. The missile guidance system does not care that silver is expensive. It requires silver or it does not work. This means that industrial demand is inelastic. It does not drop significantly just because price rises. Companies will pay more rather than stop production. And that inelastic demand colliding with restricted supply is the recipe for a vertical price move. The paper market is now in terminal decline. The ratio of paper silver contracts to physical silver is estimated at 356 to 1. For every ounce of real metal, there are 356 paper claims. This works fine, as long as nobody demands delivery. But the moment industrial users start demanding physical metal, the moment central banks decide they want allocated storage rather than unallocated claims, the moment investors lose confidence in the system, the entire structure collapses. And that moment is arriving. The $12 gap between Shanghai and COMEX is the market screaming that paper is not the same as physical. Anyone still holding unallocated silver accounts, anyone holding ETFs that do not guarantee delivery, anyone holding futures contracts they cannot take delivery on, they are holding risk. And when the default happens, when the exchanges announce force majeure or when ETFs suspend redemptions, that paper will be worth a fraction of what physical metal is worth. The writing is on the wall. The smart money is converting paper to physical right now, and the dumb money is going to learn a very expensive lesson. Let's be very clear about what the endgame looks like. This is not a normal commodity cycle. This is not a situation where high prices bring new supply and the market rebalances. This is a structural break. The supply that the world depended on for decades, that 70% that came from China, is now restricted. And even if other countries try to build refining capacity, it takes years. During those years, the deficit persists. During those years, stockpiles continue to drain. During those years, industrial users compete for every available ounce. And during those years, price goes to whatever level clears the market. If that level is $100, the market will trade there. If that level is $200, the market will trade there. There is no ceiling in a supply crisis. The only limit is the point where demand destruction equals available supply. And we are nowhere near that point yet. The panic buying that is visible in Shanghai right now is not retail investors flipping contracts. It is manufacturers securing inventory for the next quarter. It is government procurement agencies filling strategic reserves. It is companies that looked at the China export restrictions and realized they have 30 days of silver on hand and no guarantee they can source more. This is not speculative buying. This is survival buying. And survival buying has no price sensitivity. When your factory shuts down without silver, you pay whatever it costs to keep it running. When your military cannot build missiles without silver, you pay whatever it costs to secure supply. This is the demand that is driving Shanghai above $80. And this demand is not going away. It is accelerating. For the individual investor, this moment is binary. Either you understand what is happening and you position accordingly, or you do not, and you miss the largest commodity move of your lifetime. The fundamentals have never been clearer. Supply is restricted, demand is inelastic, inventories are depleted, governments are hoarding, the paper market is breaking, and the price is going vertical. Every piece of data confirms this. Every action by major players confirms this. China restricting exports confirms this. Elon Musk warning publicly confirms this. Bank of America forecasting triple-digit prices confirms this. The 70% inventory decline confirms this. The $12 Shanghai premium confirms this. There is no ambiguity here. The signal is loud. The question is whether people will listen before it is too late. The comparison to past commodity squeezes is instructive. In 2007 and 2008, oil went to $147 per barrel because demand from China overwhelmed supply growth. It was not speculation. It was real demand from real industrial users. In 2021, lumber prices went vertical because COVID disrupted supply chains and housing demand surged. The squeeze was real. The price eventually corrected, but only after new supply came online. The silver squeeze today is different because the supply restriction is not temporary. It is policy-driven. China is not planning to lift export controls next quarter. This is a 2-year licensing system at minimum. And the export controls could become permanent if China decides silver is too strategic to allow outflows. This means the supply shock could persist for years, and a multi-year supply shock with inelastic demand means a multi-year price spike. This is not a trade. This is a structural repricing of a critical material. The geopolitical dimension adds another layer of urgency. The world is splitting into competing economic blocs. The US and China are in open competition for resources, technology, and influence. Europe is trying to secure its own supply chains. The Middle East is diversifying away from oil dependence. Every major power is realizing that control over strategic materials is national security. And silver sits at the center of this competition. It is required for the technologies that define the 21st century. Solar energy, electric vehicles, artificial intelligence, military electronics, 5G networks, satellites, medical devices. If you do not have silver, you cannot build the future. And if you do not control the supply, you are dependent on others who may cut you off. This is why the Pentagon signed the $7.4 billion deal to build a smelter in Tennessee. This is why governments are suddenly treating silver as a critical mineral. This is why export controls are proliferating. The age of globalized commodity markets is ending. The age of resource nationalism is beginning, and silver is the leading indicator. So what does this mean for price in the next 30 to 60 days? The technical and fundamental picture is unambiguous. Support is at $75. That level has been tested multiple times and held. The next resistance is at 85, then 90, then 100. Each of these levels will be tested and likely broken as the supply crisis intensifies. The Shanghai premium suggests that physical metal is already trading near $90 when you account for delivery premiums and logistics. As more buyers realize they cannot source metal at COMEX prices, they will bid COMEX up to match reality. The convergence between paper and physical is inevitable. The only question is whether it happens through COMEX rising or COMEX losing all credibility and becoming irrelevant. Either way, the price of real metal is going higher, and the speed of the move will surprise even the bulls. Squeezes do not move in straight lines. They move in stair steps, and then they go vertical. We are currently in a stair step phase. The vertical phase is coming. The risk to this thesis is minimal. The only way silver prices decline significantly from here is if China reverses the export controls, which they have no incentive to do, or if global industrial demand collapses, which would require a severe recession. But even in a recession, green energy mandates continue. Government spending on infrastructure continues. Defense spending continues. The demand base is diversified enough that a recession would not eliminate the deficit. It might slow the rate of increase, but it would not create surplus. And any economic weakness would likely trigger central bank easing, which would weaken currencies and make hard assets more attractive. So the downside case is limited. The upside case is explosive. This is an asymmetric trade. The risk reward is heavily skewed to the upside, and the time to position is before the crowd realizes what is happening. For those who already hold physical silver, this is validation. The thesis is playing out exactly as predicted. The paper market is breaking. Physical is decoupling. Governments are scrambling, and the price is rising. The decision now is whether to add to positions or simply hold and wait. For those who do not yet hold silver, the decision is more urgent. Every day that passes, the price is higher. Every week that passes, availability decreases. There will come a point where physical metal is simply not available at any price in the retail market. Dealers will be sold out. Mints will have months-long wait times. Premiums will be 30, 40, 50% above spot. That point is not far away. The smart move is to secure metal now, while it is still obtainable and while premiums are only 10 to 20% above spot. The final point is about the magnitude of what is happening. This is not just another commodity rally. This is a systemic shift in how strategic materials are valued and controlled. For 50 years, silver was treated as a commodity that would always be available. Miners would produce it, refiners would process it, markets would distribute it, and the price would fluctuate but stay range-bound. That era is over. Silver is now understood to be a strategic asset that is scarce, essential, and subject to geopolitical control. This realization is repricing the entire market, and the repricing is just beginning. The price at $100 will seem cheap when the market is trading at $200. The price at $200 will seem cheap when industrial users are bidding $300 for guaranteed delivery. The end game is not a number. The end game is a recognition that physical silver is one of the most valuable materials on the planet because it enables the technologies that define modern civilization. And once that recognition becomes widespread, the price will reflect it. And we are watching that recognition happen in real time. Elon Musk warning publicly is part of that recognition. China restricting exports is part of that recognition. Bank of America forecasting triple digits is part of that recognition. The question is not whether this happens. The question is whether you position for it before the opportunity closes. The window is open, but it is closing fast. $78 today, $100 soon, and then the real move begins.